Welcome to Money Matters. My name is Jim Butler with Marcum Wealth, and we have a rather interesting and unique guest on today. I think it'll affect all of us in some way, some fashion eventually, and we'll get to that soon enough. In the meantime, my co-host tonight is Mike Deaver of Brandywine Asset Management. Welcome, Mike.
Hi, Jim.
Good to catch up again. We'll run through a brief intro and try not to date ourselves as to when you and I are talking relative to when this gets shown. But I think 2023 is unfolding to be a rather interesting year for any number of reasons, not the least of which we hear about just about every day in the media, what's going on in the Middle East and abroad, and as well as the challenges that we have right here in the United States. But we can't fix that, and obviously we're not really going to get into geopolitics, but rather what's going on in the market and how does that affect many of the folks that we serve and our customers and our clients. So with that as kind of setting the tone, Mike, let me just start out and ask you, what sentiment are you hearing in conversations with clients currently?
It's really interesting because individually people seem to be doing fine. They're doing well with their own finances and their own investing, and they seem to be rather upbeat. But when you ask them about the economy and what they think in general, they tend to be pretty negative. And the latest survey just came out with the Michigan Sentiment Survey. It goes back decades. Is at recession levels as far as sentiment right now. So people are very negative on the economy and on business, while at the same time, the economy and business is thriving.
Right, right. Yeah, and just recently we saw, initial third quarter numbers on GDP that came out. They were very healthy.
Yeah.
Granted, it may slow down in the fourth quarter, but on a year-to-date basis, those are all positive numbers.
Yeah, I mean, we had a big acceleration. I mean, we're supposed to be in the middle of a recession right now, right? This is what you've been hearing for the last year. I was one of those. I didn't think we were going to avoid a recession when you were raising rates at the rate you were going, and you had the inverted yield curve, which was essentially, 100 for 100 in predicting recessions, whatever the number is, but it was highly accurate. And we had a bit of a slowdown, but we haven't had anything approaching a recession. So I think it's really shocked people. And that latest GDP number over 4%, that's pretty powerful.
Yeah, no doubt, no doubt. Well, one thing that I do share with clients, and we gently remind them, be careful who you listen to, because the media can certainly be, somewhat negative, just with regards to, really now that we have two wars taking place abroad, and those aren't going to end anytime soon, unfortunately. At least it appears to be that case. Then when there's that continued backdrop of the recession, as you mentioned, if it didn't happen this year, or if it's not going to happen this year, there's certainly enough talk about how that's going to unfold into next year.
Mm-hmm.
And then when you look at major indices, one that we refer to quite a bit is the S&P 500, which of course is a barometer of how the stock market is doing here, primarily in the U.S., although it's made up of many international or multinational companies.
Correct.
And I put pencil to paper recently just to kind of get a feel for, how things went in the first part of the year and how things have unfolded since then. And, fast forward to keep it really simple, the first 7 months, so through the end of July, actually the S&P was up almost 20%. It was, really on a nice uptick. But then, more or less the second half of July is when things started to turn. And so from August, let's call it, through the end of October, we see the S&P falling off about 8.5%.
Mm-hmm.
And that also is, let's use the term recency bias. So it's more the recent minus 8% that people are feeling versus the positive 20% in the first part of the year. And year to date, it's a positive 9%.
Yeah, you know what? I agree with that, but it's also, I think, an element of the very weak breadth across the market, and the
Okay,
fact that if you take out the Magnificent Seven, as they're calling it, the Microsofts and Facebook and the companies that are really rocking it, you end up being down on the year instead of up 7 or 8, 9%. And
right,
so a lot of the people, even though the S&P is up, they may not have the same allocation to those large cap growth stocks, tech stocks, as the index has. And
right,
and so because of that, then they actually might not be making money this year.
right, right. Now, I don't know what the number is, but if you take the S&P 500, I believe there's about 505 companies in that index. And right to your point, less than 10% are really driving those positive returns,
That's right.
whereas the vast majority, call it the remaining 490 stocks, could in fact be in negative territory this year.
Right. That's exactly right. So it gets down a little bit if people don't have a broad market exposure, if they've been picking value stocks, for example, or some of the small cap stocks that have really lagged. Um, yeah, they're nowhere near what the indexes are saying they should be at, and that will provide some negativity, I'm sure, on a sentiment basis.
Well, that actually can lead into our question, because you're touching on something that I think it addresses the question with regards to, so what does that mean to me as an individual, or as one of our listeners might ask? And Nancy Robinson in Philadelphia is asking the question, what are ETFs and how do they work?
Yeah, so the ETF is just a structure for an investment fund that people can go into. Everybody's heard of mutual funds. ETFs is just another type of fund similar to a mutual fund, except that it trades like a stock is one of the main things. So instead of just being able to invest at the end of each day, you can invest in ETFs throughout the day like a stock. But otherwise, today, you can pretty much get an ETF for most of the existing mutual funds that are out there that people tend to invest in.
Right, right. And that gives you the broad market exposure. So you don't have to worry about, hey, what are the next, glory stocks going to be in the next period going forward?
Absolutely.
Take a much broader look. Thank you, Mike. That's a really succinct answer. And if you have a question that you'd like somebody on our panel to address, here's how you send in your question.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Well, moving forward to our guest, today it's Monica Eaton of Chargebacks911. And welcome, Monica.
Hi, guys. Thanks for having me. Good to be here.
You bet. So I think to set the stage, I alluded to in the very beginning that I think everybody has, experienced something that your company addresses. So let me just ask you, tell us briefly about Chargebacks911.
Sure. So the name should say it all. Obviously, we work in the payments industry. So this means transactions between buyers and sellers. And we provide software solutions that help expediently manage disputes or chargebacks. So our clients include business owners, e-commerce merchants, as well as merchants all over the world, and financial institutions and fintechs.
How did you get started in that business? What was it that drove you into finding a solution for chargebacks?
So I think great story. Like, this is, even though, it's our story, I think it's one of the best stories that I've heard of to date. So originally started out as an e-commerce merchant myself. I wanted to be the next eBay and had a marketplace. And, you know, like any business owner, the last thing that you think about is what happened in the past. You're focused on getting more customers, growing your business, making the product even better. And, you know, this was over a decade ago, and I was doing business internationally, and I had chargebacks. I didn't even know how to spell chargebacks, and you couldn't even find it online on Google anywhere. So fast forward, I did what probably any entrepreneur does, solve the problem, necessity, and the name Chargebacks911 was born out of, you know, I created this website. I thought after I solved my problem, maybe I could help a few others. But I didn't realize it was such a huge problem industry-wide, and I wasn't the only one that had this problem. So Chargebacks911 as a merchant, what I wanted is to dial 911 and be rescued from chargeback hell. And it's one of those crazy stories. After a matter of weeks, I was contacted by the New York Times, Wall Street Journal. And, you know, it was at that point I had an epiphany. I thought, you know what, actually, I want to build a chargeback platform. I want to solve a problem, you know, worldwide for merchants similar to myself, and then discovered this is a problem that actually is an Achilles heel for large financial institutions, basically any buyer and seller. And so, yeah, that was, geez, from 2011. So it's been a great journey so far.
Monica, can you give us an example as to how somebody's going to, first of all, identify the problem, and then potentially say, I need help. I need to reach out to Chargebacks911.
Yeah, sure. So, you know, listening to some of the topics on this show, I think it's, you know, you talk about how, you know, looking at the market, the S&P is kind of a barometer. Well, if you consider chargebacks, right, this is really a barometer in every single business to help understand how each of your business units or departments are doing. So as a merchant or as a business, even as a financial institution, regardless of what business you are, if you buy and sell goods, then you have transactions. And when you have disputes, then, you know, you're going to have some noise, and that includes a chargeback. So what happens as a business, if I'm an online merchant, then I sell a product to a consumer, my consumer, instead of contacting me, they contact their bank, and their bank, you know, files a chargeback. And what happens as a business owner is I receive a refund. I'm basically forced to refund that transaction. And then it goes into a process that could take up to 90 days to reconcile and find out what actually happened. So the problem with chargebacks is that many business owners, first and foremost, don't understand how to get access to this data, which is super important, because if you get too many chargebacks, then you can end up paying fees, fines, penalties, and eventually it can really damage your reputation in the payments industry. But it's also important to understand what improvements you might need to make in handling your customers. Are you getting chargebacks because your customer service is taking too long to answer the phone? Maybe you have a problem with your shipping and fulfillment company. So what our solution does is it helps really automate a lot of the processes that are required so that business owners can first and foremost understand the chargebacks that they have and understand how to respond to those chargebacks. And most importantly, help understand what has created those chargebacks. So we provide a software that helps exchange information effectively between the buyer and the seller so that both parties can create more integrity, understand where their mistakes are, and you know, help protect really their sales, their revenue, and grow their business.
So it's a software solution. Is it like something you're hosting, or do they buy software and put it on their computer? And then is it a big database then of all these different interactions you have with the customer that you're able somehow to run metrics on to determine, oh, you need to improve these procedures?
Similar to that. So if you consider today, one of the challenges that exist in our industry is that if you are processing credit cards, then chances are you get a new merchant account, and this is what you use to take credit cards. And e-commerce is growing by leaps and bounds. We see a lot of change industry-wide, worldwide, especially on the back of COVID. So you really can't even be in business unless you can process credit and debit cards today. But when you process credit cards, most businesses are very in tune with how to charge a customer and how to refund a customer. Now, what happens is you may receive a chargeback, and this chargeback is through a totally different channel. It's probably getting mailed to you. Maybe you receive it through a web portal, you receive it through an email. And what the merchant or what the business owner now has to do is they have to receive that piece of information. They have to understand or match what order or transaction that relates to. And then they have to identify what information they have related to that. In other words, was it fraud? Did they have a problem with their fraud filter or their technology system? Is the customer saying they didn't get a product? Is there some other type of claim? And there's all sorts of codes. If you think of kind of like the payroll system, 20 years ago, right? All of us had payroll clerks, and each of these individuals knew every tax law. They knew all the different laws, and everyone had a whole payroll department. Fasting forward, even if you have one employee, you use software because the software manages all the changes, all the liabilities, all the rules. Chargebacks is something very similar. There's lots of rules, hundreds of rules. There's different rules for Visa, for MasterCard, American Express. There's different rules in every country. So our software system really internalizes all that information, helps maintain all the connections so that merchants and businesses can exchange the data that they need to make sure that they're compliant. And we manage all the different rules and changes according to all the parameters for all these different payment methods. Does that make sense?
Sure it does. Yeah. So your customers would primarily be any organizations, Monica, involved in e-commerce where they're collecting or distributing money. Is that fair?
Yeah. So our customers are anybody that really touches the chargeback process as a business. So this is going to be, businesses and they don't just have to have e-commerce. So interesting statistic with chargebacks. And this, I think, really plays into some of the, you talk about the financial instability that I think a lot of this, I think, is driven by media likewise. But if we take a look at chargebacks as a barometer as well, it really underscores some of that instability or financial insecurity that may be harboring consumers. This is a great indicator if we look at where the market is going. So, for example, e-commerce as a sales method is growing by 15 to 17% year over year. After COVID, we saw a structural shift, and forever the world has changed. We're becoming much more virtual. However, chargebacks, as a result, is growing above 20% year over year. Now, an e-commerce transaction is 50 times more likely to turn into a chargeback. Why is that? Well, because you have a consumer and it's a faceless transaction. There's more opportunity for fraud. There's more opportunity for issues, and behaviors as consumers have also changed. Our expectations have changed, etc. So whilst the majority of chargebacks are coming from virtual transactions, there's still increasing chargeback behavior that is coming from, quick service restaurants, high retail goods, department stores. Literally, if you have any business in the whole world, they probably also are dealing with this chargeback behavior. And part of that is, some of the financial instability, insecurities, because it's a way that consumers have to claw back funds if they overspent, etc. A lot of it is just, lack of education. Some of it is lack of, more sophisticated infrastructure that can support all the momentum and change. But yes, we work across the whole gamut, and we support every type of payment method, and large financial institutions down to the smallest organizations.
So will you work with things like PayPal and any
Yes.
transaction, not just Okay. And then how
Yep.
how do you
Yes.
get paid on that?
So to your point, I'll answer your question quickly. So to your
Yeah.
point, a customer of ours, a business, can connect to us, and it's one single connection. They don't have to download software on their computer or anything like that. It's a SaaS solution. So everything we have is in the cloud. So they simply can subscribe to a solution, and now we automate everything. So we'll connect to all of the different, services that they may have. Maybe they're using PayPal. They also have, an account with Chase, maybe, different processors, Stripe, etc. And so we provide one single connection, and then we normalize all of that data and also provide the connections to whatever, tools they may have. So they have plugins and it can be automated. So in terms of how we're paid either a subscription fee on a monthly basis, a per transaction fee. So there's a couple different models dependent on, the size of the client, whether they're, smaller, medium, or enterprise level. And it's a SaaS type of solution that, they have an a la carte menu. They can add different services, and yeah, they have a few different service levels.
Do they actually end up saving money because of the corrections you make, improvements to the chargeback process, or how does that?
Yes, so
that
that's a great point. So so interesting statistics. So when it comes to chargebacks, for $1 in every chargeback, a merchant or a business owner is literally spending over $3. So, and one of the reasons why this is such an expensive, cost, you have to think of it as a business. Every single chargeback is not just the cost of the chargeback, but you lose the merchandise. You could potentially lose the customer. If you don't respond in time, you could end up paying additional fees and fines, penalties. But in addition, it's even more costly when you consider how much are you losing on a future basis because you failed to identify perhaps, revenue that is getting siphoned from your organization and you don't know what hidden errors exist. So it's absolutely crucial that you understand, what type of chargeback exposure you have. And a lot of chargebacks today are also being filed accidentally because the world has grown so rapid in the virtual space. Many consumers don't know that contacting their bank is not the same as contacting the business, and contacting their bank, ends up creating what may look like a fraud claim, but actually maybe they just want to cancel subscription. So there's lots of integrity challenges in this mechanism that can also increase costs. So at the end of the day, businesses have, I say they don't just have the right, they should have the responsibility to provide valid feedback, make sure that banks and consumers and really the whole ecosphere is getting, more integrity to understand what was valid, what's not valid. And specifically, businesses and merchants have rights to contest chargebacks that may have been accidentally filed. And if they do that, then they end up getting, they recover the money that originally they were debited. But most importantly, so they can make money or they can recover funds. But most importantly is really the insights to understand how they can continue to improve their business and also improve the customer experience, which at the end of the day is really what everybody cares about most.
So is there any data, Monica, on the losses that an e-commerce firm experiences, and then how engaging with your firm can actually save them money? Because that's going to be critical for them to understand first, how much are they losing, and then how much can they get back in order to minimize those losses. I don't know if it's available.
Yeah. So in terms, if you consider, I think industry wide, it's been published just a 3-to-1, return on investment for businesses to utilize, solutions like ours that ensure that responses are put in place, timelines are paid attention to, et cetera. And then in terms of, it's not just the cost savings again, this is really putting an investment in not just protecting your business and recovering funds that shouldn't have been lost, but every business today. I mean, I think the latest forecast from LexisNexis was showing that an average business owner today that operates in the e-commerce space, which is most businesses, is spending up to 10% of their total revenue on preventing fraud. So if you don't have the insights that come from chargebacks, then that cost is going to continue to increase. And you're going to be spending a lot more money to acquire customers that you aren't keeping at the end of the day. So it really is, two-pronged approach that is incredibly valuable to businesses worldwide.
Right. Monica, thank you. That's a lot of information. And again, I think has raised a lot of people's awareness that, a company like yours exists. And I think chargebacks911.com is an easy place to find you and your company. I mean, our listeners, if they're consumers, aren't really going to reach out to you, as I understand it. But as somebody involved in a company, involved in e-commerce, they might do that. So thank you very much for sharing your story.
All right. Thank you. Thanks, Jim. Thanks, guys. All right. Cheers.
Bye now.
All right. So stay tuned for our future meeting. Another guest is Dan Berger of Berger Rental. And one thing that we've seen in the real estate market, over the past several years is just a boom in rental properties. And I'm talking primarily residential rental properties versus commercial properties. So Berger Rental is very involved in that. So stay tuned and listen to his story. And in the meantime, thanks for listening. Hope you've picked up a few pieces of information, and thanks for tuning in. Oh, thank you. Yeah, I forgot about that.